Crypto markets has been thriving for years and there are plenty of ways to earn income on it. So what if I told you there is a way of trading with very low risks and almost everyone can do it? This way is called arbitrage. What is arbitrage? Arbitrage is a very simple idea. It means taking advantage of differences between prices for the same financial instruments on different exchanges. Let's imagine one city with two markets. On one side we have market A and on another market B. There are two identical products on these markets. For example, oranges. Oranges on the market A and oranges on the market B are similar. However, the price of one orange on market A is 50 cents and price of a similar orange on market B is $1. How can we take advantage of this situation? We can start buying oranges on market A and selling them on market B. If we have $100, we can buy 200 oranges on market A where their price is 50 cents per orange. Then we sell these 200 oranges on market B where their price is $1. In the end, we have $200. By doing so, we would need to pay gas fee in order to transport these 200 oranges from one part of the city to another one. Let's say the gas price is $15. This means that we have to spend our initial $100 to buy oranges plus $15. In the end, we get $200 back. Therefore, the actual profit makes $85. We can repeat this process until the prices of oranges would be almost identical on both markets. By using this price difference, we also influence demand and supply for oranges on both markets. The price of oranges on market A will increase since we increase the demand for oranges. However, on market B, the price of oranges will start to drop since we increase the supply of oranges. This is a very simple analogy that explains arbitrage. So what if I told you this kind of situation exists on financial and crypto markets? It's very common to have same coins, tokens, or currencies priced differently on different platforms, and you can use this situation to earn profits. In fact, it's not a new technique. It has existed on financial markets for a while. When it comes to crypto, there are plenty of exchanges. There are so many trading pairs and assets on these exchanges. Their prices vary. Essentially, we have big exchanges with a pool of liquidity, and we have small exchanges that follow big exchanges' prices. These prices aren't usually updated in real time. This is why an arbitrage opportunity exists. Crypto arbitrage helps traders to take advantage of the price differences by buying cryptocurrency on one exchange and selling it on another immediately. If you would like to see an example on real exchanges, you can go to CoinMarketCap and check different exchanges and their asset prices. In most cases, you won't find big differences. However, sometimes there are huge price differences such as 2, 5 or even 15% for some trading assets. Sometimes different exchanges do promotional activities when you can get additional coins or tokens if you use specific exchanges and deposit on your account. You can use it to earn profit. There are different types of arbitrages: simple arbitrage, triangular arbitrage, and risk arbitrage. Simple arbitrage means that you buy a coin or token on one exchange and sell it on another within a short period of time. You take the risk of transferring coins between exchanges, but you earn profit on the price differences. Another approach is that you can have currency and fiat on both exchanges and trade them according to the situation. So there wouldn't be a transaction acquired at the time of the operation. Example, if we have Ethereum on Binance that costs $2,000 and we have same Ethereum on Coinbase with the price of $2,050, we can spend $10,000 and buy 5 Ethereum on Binance. Then transfer these 5 Ethereum to Coinbase and sell them, those getting $10,250. $250 is the profit. You should also count the transaction time, gas fees, and exchange rates. Triangular arbitrage is a little more complicated compared to simple arbitrage. This type of arbitrage usually involves two trading pairs of three assets, and there is one same asset in these two trading pairs. Example, we have Ethereum to USD on Binance Exchange and Ethereum to Euro on Coinbase. For example, you buy 5 Ethereum with USD on Binance, then transfer this Ethereum to another exchange and exchange them to Euro. Then you convert Euro to USD and make profit from it. The complication here is that the process has multiple exchanges you need to take into account. However, it can also be on one exchange. This type of arbitrage is harder to find these days, since there are a lot of robots that are constantly looking for these kinds of scenarios and using them. Another way is risk arbitrage. So give you an analogy, let's say there are two companies on the market, company A and company B. The news come out that company A will acquire company B. The value of company B will increase as a result of this acquisition. You can take the risk and buy company B's stocks. If the information was correct, your investment will work, but if the news were fake, that will lead to losses. This is what's called risk arbitrage due to the uncertainty inherent to it. On crypto market, you can hear about a promising coin or token that's getting listed on an exchange or a cooperation between multiple projects. This creates behavior spikes that decide price changes on multiple exchanges. There are multiple ways how you can use arbitrage techniques to earn money. For example, you can use fiat or even futures, long or short orders after you find a difference on the markets. Let's say we see Ethereum on Binance with the price of $2,000. $2,100 is the price of Ethereum on Coinbase. Thinking that there will be a lot of people exploiting the arbitrage situation, we reckon that the price will eventually be almost identical on both exchanges. Let's say $2,050. So what we do is that we open Ethereum long position on Binance and a short position on Coinbase. After the price is near $2,050, we close both positions and make profit. The advantages of arbitrage trading is that the risks associated with it are generally low. However, they are still present and we will discuss them next. Risks. Do not use not legitimate exchanges. The exchanges you can't trust or those that can be easily hacked increase your risks to lose your deposit. Network and withdrawal speed. As you find a good situation on the market, you need to find out the network speed of all transactions if you would like to proceed. Often the window of opportunity is very short, and if the transaction speed is slow, you won't make profit but lose money. Price adjusters and exchange rate adjustments. There are multiple systems when it comes to adjusting the prices between exchanges. You need to monitor the prices constantly to be sure that the opportunity is still there. Minimum input cost and fees. You would need to calculate the minimum input costs since there are transaction fees that are particularly important if you do multiple transactions and withdrawals. Volatility and news. Count them in. Depending on the volatility of the pair you are trading, you can maximize or minimize your profits. So while you are executing arbitrage, make sure you are constantly monitoring it. Terms and services. Before proceeding with arbitrage on any exchange, understand their rules and terms of use. Some exchanges have multiple withdrawal limits or even have arbitrage restrictions. Accounts accessibility. To do any kind of arbitrage, you would need to have an account. Some exchanges only enable accounts for people depending on their country of residence. If your country isn't on the list, it might be a problem for you. Taxes. Depending on your citizenship or country of residence, different tax rules apply. Make sure you know them. So how to find these arbitrage opportunities? Many people do so manually. But there are a lot of screeners which constantly monitor multiple exchanges and assets that will help you filter the opportunities on the market. How to execute arbitrage opportunity? Once again, you can do it so manually, which might make the process rather complicated and repetitive. To avoid that, you can use a robot or a bot to help you execute the operation precisely. There is a bunch of robots on the market already, but if you have programming knowledge, you can write a bot script for yourself. As I said before, you would need to calculate the situation precisely. Also, you would need high network speed and up-to-date news about currencies you are looking to arbitrate. Don't forget to calculate additional costs necessary to execute it. Conclusion. It seems that modern technologies reduce certain opportunities when it comes to crypto. So many automated trading robots constantly monitor arbitrage opportunities and exploit the system, which is why these opportunities are harder and harder to find. The more people use this technique, the less opportunities are out there. There is no magic formula, but knowledge, risk management, and self-control. But like any good trading secret or system, it can either be a gold mine or a hole, depending on how many people use it. So calculate your risks and do your research before doing arbitrage. This video doesn't contain advice provided by a financial advisor. The information is my experience and knowledge. I've been using arbitrage for a while, however, such opportunities are now rare. Some traders, though, use this system constantly and it works for them. If someone tells you about a system with no risks, that's a lie. There are always risks, though they can be low or high. This was our video for today. Please don't forget to subscribe for more videos about investing, trading, and crypto. I'm Vlad. See you next time.